Hello, Stephen Cruz here with mymortgagebroker.com, and I just wanted to take an opportunity today to review one of the mortgage payment calculators we have on our website. It's just a standard basic mortgage payment calculator, but it's designed for Canadians. If we go online, we might find lots of different mortgage payment calculators, but not all of them will give you exactly the same number as a Canadian calculator will. Before we go on, make sure you click subscribe and like this video so that your friends and everyone else can see these, and when I put out new videos, then you will get to see them when they're out. Anyway, so let's talk a little bit about that mortgage payment calculator and how it works, and so that you can play around with it. I'm going to share my screen, and then we can play. I'm going to move my picture down to the bottom here, and hopefully that helps. So the mortgage payment calculator on my website is found at mymortgagebroker.com/mortgage payment calculator Canada, and it is specifically designed for Canadians. Canadian mortgage payments are calculated based on an interest rate that's compounded semi-annually, not in advance. And so the other calculators online, you'll find they typically compound monthly, and the US mortgages are compounded monthly, which actually causes them to be a little bit more expensive than a mortgage that's compounded semi-annually. In Canada, there's a couple of lenders who do compound their mortgages semi-annually, but those are for variable rate mortgages, and they will compound those monthly, and you have to keep an eye on that because it makes the interest rate slightly higher than if it was compounded semi-annually. In Canada, the interest rate is actually legislated. So for a traditional fixed mortgage, all mortgages have to be compounded semi-annually, not in advance, and that is required by the legislation. So on this page, I have a calculator that's near the top. It's our mortgage payment calculator, and basically what it does is it just gives you an idea of what the mortgage payment is. I have some other little factors in here to help you to figure some other things out, so just to add some extra value. But let's say you're purchasing a house for $500,000, and you had 5% down, and the interest rate you could look at, let's say 259. Let's look at that today. 259. You have 5% down. You choose a 5-year term, which means that the interest rate is fixed or guaranteed for that 5 years, and at the end of the term, it's completely open for you to pay out or switch or move or renew or whatever without any penalties. And then let's say the amortization is 25 years. Typically, amortizations, most people, well, you cannot exceed 25 years if you have less than 20% down. If you do have 20% or more down, then you can choose an amortization that is 30 years, and there's a number of lenders who offer 30 years. This calculator only goes to 25 because there are some other calculations that require qualifying, and I'm making assumptions related to the qualifying, so I have to use a 25-year here. If you wanted to find out what the payments are over 25 or over 30, then please just fill in your name and email here, connect with us. This says apply for pre-approval, but basically you'll connect with us, and then we can chit-chat and give you some more details. But this, for the purposes of this calculator, the maximum amortization is 25 years. So let's say 5% down, interest rate 259, 5-year term, 25-year amortization. If you wanted to, you can also put a property taxes in. So let's say $3,600 for property taxes, and then 0 condo fees. So the reason I have these in here is so that it can give you a bit of an idea of how much money you can qualify for income-wise, or how much income you need to qualify for this purchase price. So this $500,000 purchase price works out with a 5% down. So 5% down works out to be a $475 net amount, plus an default insurance premium of $19,000. And as you probably know, if you've watched some other videos, the default insurance premium is there to protect the bank. You pay it, it's added onto your mortgage, but it protects the bank and protects the lender. If you stop making payments, the insurer will take over the mortgage and try to recover the funds, but give the bank their money back. So it's an insurance policy for the bank. So the total mortgage amount works out to be $494. 475 plus 19 is $494. Your payments on that, based upon the interest rate we chose of 259, is $2,239. And with property taxes of $300 a month and no condo fees, your total payment works out to $2,535. The income you would need to qualify for this purchase price is $87,700, and that's before taxes. So that's assuming you don't have a ton of debt. If you have some debt, that can affect this. I did not include any debt calculations here for that, but you can use a different calculator that I've created called the mortgage pre-approval calculator. If you know the number, you can actually go in and play around with your debt to see if you still qualify or not. And the mortgage pre-approval calculator is here, mymortgagebroker.com/mortgage pre-approval calculator. And in here, we put some debt numbers in. So you put your annual income in, some debt numbers, and then it lets you know what your purchase price is that you would qualify for. So it's that's there. This calculator does not do that. So after the 5-year term, you can see that you have paid your mortgage down from $494,000 to $419,000. So that's a 70 some, almost $80,000 principal reduction over 5 years. If you want to see what you do after 1 year, then you can just move it down, and then it tells you after 1 year you would have paid down to $480,000 effectively, so about $14,000. So a little over $1,000 a month is going towards the principal at this interest rate. So that's quite good. Let's look at another number. So let's use $750,000. So $750,000. Let's say you have 10% down. Before I say 10% down, let's say 10%. Sorry, 10% down. So $750,000 with 10% down, your interest rate's the same. The term 5 years, 25-year amortization, and let's use $4,500 as the property taxes and no condo fees. Your purchase price $75,000, the down payment $75,000, 10%. That nets out to be $675 net amount plus the insurance premium. So total mortgage is this. Your payments are $3,150 a month approximately. With property taxes, you're looking at $3,500 a month for a $750,000 purchase with 10% down. The one caveat to purchasing a house over $500,000 is that the legislation requires that you have 5% down on the first $500,000 and then 10% on the rest. And so in this case, did we do that? I'm not sure. No. So this calculator does not factor that in. So it's important for you to know that if you purchase for $750, you actually have to put so you'd have to put 5% down on the first 500, which is 25,000, and then 10% on the rest, which is another 25,000. So the minimum down payment would actually be $50,000 for a purchase price of $750. I actually might fix that on this calculator. We'll see how complicated that is, but at the moment, this does not factor in the minimum legislated requirements. So that is something to be aware of. If you have any questions about what you qualify for and how much your payments are, what current interest rates are, then please connect with us. You can just fill this in, press the submit button. You'll get a copy of all the details you input as well as your answers. And then we'll get a copy, and then we'll connect with you. Myself or a member of my team will connect. So don't forget to subscribe and like our little video, and we will see you again the next time.